What's the difference between investment return versus investor return? Most people don't realize that when they hear the average return on CNBC or NBC when they're doing Market Watch or whatever, they're hearing the average investment return, which is a far cry from what investors are actually experiencing. So get ready. In this episode, I'm going to explain the difference and why it exists and what you can do so that you don't get sucked into thinking you're earning average returns of 9 when they're only really 3.5. Okay, so get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. Now, I help a lot of people prepare for a comfortable retirement. And a lot of times people get confused because they listen to the news or they go in and meet with their advisor and their advisor says, well, the average return of the S&P 500 has been 9.14% for the last 20 years. And but they can't figure out, well, how come they're only averaging 3.5? So let me tell you the difference here. And this is actually what precipitated the 4% rule in the financial services industry, which is pathetic. So get ready. Stay with me the entire episode if you want to see how to not get duped. Okay. Now, a firm that studies investor behavior, they're called Dalbar. Dalbar has tracked investor behavior for decades. Years ago, they did a study of every 20-year period, clear back to the Great Depression, okay? And they basically said in this report that if you take any 20-year period, if people in America would invest in the market, and let's just use the S&P 500, that's a good measurement, you would average 9.14% before tax. If you diversified in the S&P 500, and if you just bought and you held, you didn't panic, you didn't sell, you didn't try to time the market, you would earn 9.14%. What does that mean? It means that your money, you divide 9 into 72, your money will double every 8 years. And so let's say you did that and you started out with $250,000 and it doubled to 500,000 and then it doubled to $1 million, okay, in 16 years. And so what we're talking about here, you have $1 million nest egg. And now if you're earning 9%, you think, well, I'm averaging 9%. So you can pull out 90 grand a year. No, it's the sequence of returns that matters, not the average rate of return, which is a whole other concept I explain in other episodes. Folks, if you pull out 90 grand a year, if you earn 9% each and every year, okay, you pull out 90,000, that's not all your money. Most people who save money are in at least a 22 to 24% tax bracket. And those tax brackets are going to go up to 25 and 28. Plus 41 out of 50 states has a state income tax bracket. So many taxpayers in California, for example, they pay 33 to 40% in tax. Let's just keep it simple. Let's use 33% because it's 1/3. If you're earning 9, you're only netting 6. 1/3 belongs to the government. You pull out 90 grand, you owe 30,000 in tax to the government, and you have a net of 6% or 60,000, which is 5,000 a month to buy gas, groceries, prescription, and golf green fees. Okay, you're barely making it, even though you're earning 9%. But see, Dalbar said, that's not really what's happening. Most investors in America are only earning 3.83. Why? Because most investors, especially retirees, they get involved emotionally, okay? So they have, let's say, $1 million nest egg, and they're retired, and it's in the S&P, in the market, and all of a sudden the market starts dropping like it did in 2001 to 2003. It dropped 40%. That $1 million goes down to 600 grand. Or in 2008, during the mortgage meltdown, it went down 40%. Or how about COVID-19, March of 2020? It dropped 30%. $1 million drops down to 700,000. Now, most Americans can't stomach that. That's their nest egg. When they see that $1 million go down to 900 grand and then 850 and 800,000, just 15, 20%, they go enough already and they sell. When it drops 25 and 30%, most Americans sell. So they sell low. And then what? They wait till the market has come back up substantially, and then they finally buy back in high. That's the opposite of what you want to do. But because of emotion, most investors are only averaging 3.83. They had to revise this a year later, and it was 3.49. Most Americans are only earning 3.5%. Here, as of the recording of this episode in late April of 2025, this was the most recent Dalbar report, okay? The average equity fund investor underperformed the market. Most people are earning 5.5% less than the S&P 500, okay? That's what I was basically showing you. They're earning less. If you bought and held, you'd be earning 9.14 instead of you're getting 3.5. You're earning an average of 5.5. This has been true for decades. Why are people earning 5.5% less than the S&P 500? It's because they're buying and selling at the wrong time. They panic. Okay. The average fixed income investor earned 2.63% less than the Bloomberg Barclays Aggregate Bond Index. Okay. So this has been going on for quite a while, folks, and I recommend you don't buy into that because the financial services industry, they realize that most of their clients are only averaging 3.5%, not 9%, because of reality, these reports, okay? So this is what precipitated the 4% rule in the financial services industry, okay? What is the 4% rule, if you don't know? Most broker-dealers and financial firms, Wall Street was never designed to create predictable cash flow. They tout that they hope to earn you, 9 or 10 or 12%. But if you ask them, well, illustrate a retirement income on my $1 million, illustrate a 9% payout, they won't do it. They'll only show you 4%. In fact, if you pull out more than 4%, they'll probably have you sign a waiver, a hold harmless agreement that you will not sue them for you outliving your money. Did you know that? So that's called the 4% rule. Now, if you pull out 4% a year out of your nest egg, you'll slowly deplete it if you're only earning 3.5, because you're only earning 3.5 and you're pulling out 4. You're slowly going to deplete your nest egg, but not before your LE. That's called life expectancy. And so that's called the 4% rule. They even want to lower it to 3%. That's pathetic. The 4% rule is pathetic. Why? Let's say you wanted an income of $50,000 a year. Okay, $50,000 a year. That would require a $1,250,000 nest egg in an IRA or 401k in the market at 4%. 4% of that is $50,000 a year. If you're anything like me, I don't accumulate $1,250,000 to have a measly $50,000 a year of income. But that's the financial services industry standard. That's before tax. If you're in a 22 or 24% federal tax bracket, and you have another 4 or 5% on top of that in state, you're gonna pay 28%. 28% in tax on that. You're gonna pay $14,000 in tax. You're only gonna net $36,000 to buy gas, groceries, prescriptions, golf green fees. That's $3,000 a month. That is so pathetic. Why do I think it's ridiculous? Because my favorite financial vehicle, a laser fund, you will earn rates of return if you diversify and rebalance by meeting with your advisor once every year. We usually earn rates of return of 11 to 14%. If you earn 11, you net 10. If you earn 9, you net 8, okay? If you earned a net of 8%, $1,250,000 nest egg could pay you $100,000 a year without depleting your nest egg, tax free. That's all your money instead of having to pay tax. How much better is $100,000 than $50,000? It's twice as much, but it's actually way better. It's almost worth triple because I don't have to pay tax on this. At a 10% payout, most of our clients on $1 million nest egg can pull out $100,000 a year. On $1,250,000, they can pull out $125,000 a year and not deplete that nest egg. Why would you generate $36,000 a year of after-tax income with your money in IRAs or 401ks in the market when you could generate $100,000 or more? It's that simple. See, max funded IUL isn't a little bit better. It's a whole lot better. So let me show you an actual example of this. We had a client come to us in 2012, okay? And this client had $600,000 in his IRAs or 401ks invested in the market. And he had $600,000 at the turn of the century in the year 2000. After the 9/11 terrorist attacks, from 2001 to 2003, he saw that $600,000 in that IRA dwindle down to less than 360 grand. It took 4 years until 2007 to come back up to 600,000. Then in 2008, as Warren Buffett put it, he said when the tide went out in 2008, it revealed who was swimming naked. Okay, they were unprotected. That 600,000 dropped down to 360,000 again. It took 4 years until 2012 to come back to 600,000. Basically, he had 12 years where he earned basically nothing. Okay, he barely came back to break even. And his advisor had the audacity to come in with him and say, I told you, if you hung in there, the market always comes back. Yeah, it took 12 years for you to come back to break even. Our clients tripled their money during that 12-year period, tax-free. You could have had a $1,800,000 by then on this if you would have had it in an IUL laser fund. But let's look at where you're at right now. Now, his advisor said, well, wait a minute. I'm going to let him pull out 4% a year or take out the required minimum distribution. 4% on 600,000 is 24,000 taxable. In his tax bracket, 33%, he was going to pay $8,000 in tax. He was only netting $16,000 or $1,333 a month. That's ridiculous. That's what his advisor recommended he do. Basically, he came to us and he performed what we call a strategic rollout. That's not a rollover. A rollover is going from the frying pan to the fire. That's taking money in a 401k and rolling it over to an IRA, deferring until you're age 62 or age 72 or 73, and then taking RMDs, required minimum distributions, and stringing it out. You're not saving tax. That's the worst advice for most Americans. You are increasing your tax out to your life expectancy, your spouses, and then as it passes down to your non-spousal heirs, they have to pay tax on that within 10 years. You're not saving tax. You're just stretching it out and compounding the problem. He got that. So basically, we did a strategic rollout of this 600,000. We didn't take it out all at once. We withdrew 150 grand a year. Worst case scenario. He pulls out 150,000. That shows up on the front page of his 1040 tax return. In a 33% bracket, he pays 50,000 of the 150 in tax. He has a net of 100,000 to go into an IUL laser fund. After 5 years, okay, because we were able to earn him a rate of return of about 8.25% while we were getting the money out, but we kept him in that lower tax threshold. So we ended up, okay, 100,000 a year for 5 years going into his IUL laser fund. He now has 500,000 in there after 5 years. That 500,000 in the IUL laser fund, if he only pulls out, 10% a year, that's 50,000. 8% a year is 40,000. How much more is 40,000 than 16? How much more is 50 than 16? Okay. It's triple. We do this all the time, but 3 times the income. Now, in actuality, what I'm not showing you here is that I'm a tax strategist. And so I resurrected some tax deductions he'd been killing by paying off his rental properties, and we refinanced them at 4.5% tax deductible interest, a net cost of 3%, and he was earning 9 or 10% on this. He was earning 3 times more than the cost of the mortgage, but the tax deductions we resurrected offset all of the tax on this. He didn't end up with 500,000 after tax. He ended up with 750,000 because we offset all the tax rolling the money out of his IRAs by resurrecting deductions he'd been killing. Now, that maybe went over your head, but if you're intrigued, you ought to engage with us, and that's what I am. I'm a tax strategist. So he actually has 75,000 a year of income. 75,000 is way better than the 16,000 his advisor said, hey, just be happy with that. See, that's unacceptable to me. If you want to read his story, it's in my book. See, my book, The Laser Fund, is 300 pages, jam-packed with charts and graphs and explanations. 14 chapters in the left brain side, if you're a left brain learner. If you're a right brain learner and you just learn by stories, you just flip it over to the right brain side. 12 chapters, about 100 pages, 62 actual client stories. One of them is the story of that man, okay? And if you want to use your whole brain, you can use your left brain and right brain, okay? Now, I recommend that you claim a free copy of this. If you go to Amazon, Amazon is selling hundreds of these a month. We sell thousands of them, but I'll gift it to you free. Now, folks, if you buy it on Amazon, it's $20 up to $60 plus shipping. If you do that, thank you. But I'll gift you a copy free. If you simply go to laserfund.com or click on the link below, you must contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. There ain't no such thing as free lunch. But if you contribute towards the shipping and handling, I'll pay for the book. I will fire out a hard copy to you via priority mail. And when you're in there claiming your hard copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can even schedule to attend a free educational webinar that we teach every single week. No cost, no obligation. But you can also schedule an appointment with an IUL professional specialist out of 5,000 that I've trained. These are the top dozen, the creme de la creme. Because if you're interested in implementing an IUL laser fund to do what I'm talking about here, it's absolutely imperative that it's structured correctly and funded properly. And you don't go to just any insurance agent. You want to go to somebody who has verified they've been trained, they've been certified. And so that's why I recommend, if you're an IUL agent, I would recommend you get certified. Check out IULinsiders.com so that you can do the best job for your clients. So here's to you and your brighter future. Don't accept the financial services industry pathetic 4% rule. I want you to enjoy retirement without panicking about having to put off retirement because the market's down. And then when the market comes back up, you don't have to worry about that because you will not lose when the market goes down with IUL. And you'll benefit when the market goes up.